Contrary to popular belief, rich people are very particular with their investments. Because of their massive wealth, they no longer want to invest in low-yielding equities, and they've developed the skill of risk-taking. In the right circumstances, investing is the most effective way to increase your money. Most investment options are available to practically anyone, regardless of age, income, or profession. But such considerations will impact which asset are the best fit for you at this particular time. Hey folks, welcome back. In this video, we will talk about investments or investment portfolios you must avoid. Of course, the decision is all up to you, but I'm just here to give you some information. Before we begin, make sure to like this video and let's start. First, invest only in stocks that you understand. Millionaires prefer to invest in stocks, but not all equities are suitable investments for the long term. In fact, experienced investors like Warren Buffett will not invest in most stocks because of how complex they can be, even though he's been investing for longer than most people have been alive. This is because many companies trade on the stock market, which is so complex that most investors cannot even comprehend what business the company is in. In his seminars, Buffett emphasizes the significance of investing only in firms that you understand. He adheres to this principle in his own investments by investing only in companies that fit inside his circle of competence, and only enterprises that come inside his circle of competence are examined for investment. And only those that fall within this circle are considered for investment. Buffett argues that it's impossible to forecast future success if you don't understand the business. Buffett did not suffer significantly when the dot-com bubble burst in the early 2000s because he did not have much money invested in dot-com stocks. In short, investing in stocks can be a powerful tool for growing your wealth, but your investments should be limited to companies you understand and are familiar with. Second, avoid investing in digital currencies. Although Bitcoin and other prominent cryptocurrencies have been the topic of conversation for several years, billionaires tend to shun this form of investment since it is considered high risk. I'd be lying if I said there weren't people who made millions of dollars by investing in cryptocurrencies. But the truth is that these folks are few. For starters, there is no government regulation of digital currencies, which is a significant drawback. This means that there is no monitoring of how the companies behind them are running, which might be frightening if you are considering investing vast quantities of money into them in the first place. The second issue with cryptocurrencies is that they do not have intrinsic worth. Their pricing is entirely speculative, which causes the price to soar when there is a lot of attention focused on them and costs to fall when the attention is waning. Consider the case of Bitcoin, which gained an absurd amount of attention in December 2017. Then, when the focus shifted away from Bitcoin, the price began to fall, as investors realized they had overpaid for a currency that was not selling less than a year after it reached its peak. Third, avoid investing in collectibles. Collectibles are the next form of investment that millionaires stay away from. Among the many types of collectibles include items such as art, antiques, stamps, classic automobiles, fine wine, and comic books, all of which are huge businesses, believe it or not. According to a survey by Deloitte, the market for collectibles was worth $107.6 billion in 2021, and it is likely to expand year on year. However, even with the anticipated increase in gross millionaires, many people are still reluctant to invest their money in collectibles for various reasons. For starters, collectibles are only worth what someone else is willing to pay for them, which means there is no defined price for these types of investments. Similar to cryptocurrencies, the asset's value is determined by how much other people believe it is worth, rather than having a monetary value linked with it in the traditional sense. Therefore, while that beautiful artwork you own may be worth a lot to you, it is worth nothing unless you can find a buyer who is prepared to part with their money in exchange for the painting. Unlike stocks and bonds, there is typically minimal public information accessible for unique collectibles, making the appraisal procedure much more challenging to complete. The second reason the wealthy don't employ collectibles as investments is that they don't provide any revenue for the owner. Sure, a picture is beautiful to look at, but it will not provide you with any income regularly, making it a less than ideal investment to hold. The inability to liquidate collectibles as an investment is, without a doubt, their most significant drawback. For example, it takes a particular customer to be willing to spend thousands of dollars on an antique vehicle or comic book collection. If you want to sell your valuables to recuperate some money, you may have to wait a long time before you receive your money. While amassing a valuable collection can be entertaining, it is not the ideal way to make long-term investments. Fourth, avoid investing in penny stocks. Penny stocks are defined as any stock that trades for less than $5 a share on the stock exchange. Millionaires avoid penny stocks like the devil since they are so volatile. Millionaires steer clear of this form of investment for various compelling reasons. First and foremost, corporations that deal in low-value stocks are not required to register with the Securities and Exchange Commission, often known as the SEC, and they are not obliged to submit annual reports to the SEC as well. To put it simply, this means that there is no monitoring of the quality of the financial information that these companies are disclosing, resulting in them being highly volatile investments. A lack of access to reliable financial information makes it extremely difficult for investors to acquire a sense of the genuine value of their holdings, which is a critical aspect of successful investing decisions. For investors willing to take a chance on these unproven companies, these stocks certainly have the potential for exponential increases and significant returns. However, millionaires are well aware that penny stocks are doomed to fail. Another reason that current penny stocks have been lousy investments is that they have low levels of liquidity, which is related to the fact that most people do not invest in these types of companies. Finding a buyer for a stock that you own might be difficult, while most popular companies are traded thousands of times per day. Penny stocks are purchased and sold far less frequently, impacting their price, which is still another disadvantage of investing in small stocks. The fact that your investment's prices are volatile makes it challenging to determine the underlying value of your holdings. It can make investing extremely stressful as you watch your money grow and fall to severe amounts over time. Fifth, avoid investing in bonds. While it is true that many millionaires do have some bonds in their portfolios, this sort of investment is often shunned by millionaires who are attempting to increase their wealth. A major drawback of bond investments is that their returns are typically substantially lower than those obtained by investing in stocks rather than bonds. In fact, many bonds make only 3% per year on average, which is not enough to keep up with inflation. For example, the average annual inflation rate in the United States during the past 3 years has been somewhat higher than 2%. This means that you would only earn 1% or $500 on a $50,000 investment. So, with such low rates on bonds, why would anyone want to put their money into them in the first place? The truth is that bonds are generally considered lower risk investments in stocks, and they are also relatively liquid, which means that if you decide to sell them, you will be able to get your money back relatively fast. Furthermore, bonds have a tendency to pay interest, making them assets that generate revenue. Unfortunately, because of their low rates, they are more of a wealth preservation instrument than a wealth building tool. So millionaires are less likely to put significant sums of money into this form of investment than other investors. Sixth, avoid investing in certificates of deposit. If you're not familiar with certificates of deposit, also known as CDs, allow me to explain what they are and how they work. A certificate of deposit is a financial instrument issued by banks and credit unions that rewards customers for agreeing to leave a lump sum deposit unchanged for a predetermined amount of time in exchange for receiving a higher interest rate in exchange for doing so. In essence, you're exchanging access to your money for interest income on your money. Unfortunately, CDs share many of the same shortcomings as bonds when it comes to yield. They do not provide huge returns, which means that investing in them will make it more challenging to combat inflation in the future. In fact, as of May 2022, the highest CDs yielded only 2.60%. One advantage of certificates of deposit over bonds is that they tend to have shorter terms, allowing you to earn a similar rate of return while only being without access to your cash for a shorter length of time, resulting in less risk for your investment. While certificates of deposit are not a bad investment, millionaires demand more significant returns and rely on these returns to develop their wealth more quickly, which is why certificates of deposit are not the investment of choice for the wealthy. 7th, avoid investing in metals, minerals, or elements. Valuable minerals, and notably gold, are among the investments that wealthy people avoid. I can see now why some people might want to put their money into minerals. To put it simply, gold and other minerals can serve as a type of insurance against economic downturns. This is because minerals have a tendency to have an inverse relationship with the equity market. Simply put, when the value of stocks and bonds declines, the value of gold and other precious metals tends to increase. Moreover, when the stock market is rising, the value of minerals falls. Your thoughts might be along the lines of, isn't it prudent to have investments that will compensate for any losses? Theoretically, this makes complete and utter sense. Unfortunately, the reality is that mineral prices do not often rise enough to make up for the losses that you would incur during an economic crisis, making them a poor hedge against economic uncertainty. So, if you want to be a millionaire, you must opt to invest in high-yielding equities than low-yielding ones. It is also important to remember the first one, which is not to invest in something you don't fully understand, since information is your greatest asset. Alright, that's it for this video. Hey, if you're new to this channel, don't forget to like and subscribe for more videos like this. Hope you learned a lot and see you next time.